So, you're locked in your money in bonds and debentures and you think it is safe? Well, you can be in for a real shock. Settle down, folks, and welcome back to the Wealth with Walunj, the show where you and I will waltz our way into the mysteries of building real wealth, one episode at a time. I'm your host, Sandeep Walunj, and the man from Motilal Oswal. And yes, I know debt feels like the plain khichdi of investments, safe, reliable, and kind of boring. And on the other hand, equities, that's the spicy biryani full of masala and drama making headlines every day. So why should anyone bother with debt? Well, you may not like the plain khichdi, but debt plays a crucial role in your financial diet. However, is it really safe? And can it actually beat equities? And if it barely keeps up with the inflation, why invest in it at all? Let's break it all down on Wealth with Walunj. Let's get this financial feast started. Can debt outperform equity in the long run? Spoiler, it's the tortoise winning a few sprints. We all know equities generate wealth over time, but guess what? Debt has actually outperformed stocks in certain periods. Yes, even the safe and slow tortoise has bitten the hair a few times. Let's look at three examples. Between 2010 and 2013, the Nifty 50 gave a dull 4.8% annual return. Meanwhile, the long-term Indian government bonds quietly delivered 8 to 9%. So basically, the tortoise had a caffeine boost. Between 2000 and 2003, the stock market went nowhere, but the AAA rated corporate bonds paid 10 to 12% annually. It's like winning a race when everyone else is stripped on their shoelaces. In 2022, recently, mid-cap and small-cap stocks crashed, but the debt funds provided a 6 to 7% returns if you remember. So when the biryani catches fire, sometimes the khichdi is still edible. But when does debt actually beat equity? So there are three broad scenarios when this tends to happen. The first one is when the interest rates fall. That's when the long-term bonds appreciate. Second is when the markets crash. That's when debt funds tend to remain stable. It's the financial equivalent of a sturdy umbrella in a storm. When the economy slows down, the corporate earnings shrink, the fixed income investments typically keep paying. Even the party gets over, the rent still needs to be paid. So debt may not be a long-term wealth creator, but it definitely shines when the stock market hits turbulence. It's the financial equivalent of a reliable backup dancer. But is debt really safe? Spoiler, it's not as safe as you think. A lot of people think debt is safe. Nothing can go wrong with my principal. Well, not always. Just because it doesn't swing wildly like a stock doesn't mean it's risk-free. There are dangers lurking under the surface here as well. So there are three main risks that are there even in debt. The first one is called the principal loss risk. You think debt can't lose money? Let's revisit some disasters. In 2018, IL&FS defaulted. Investors in debt funds also took heavy losses. It was like a financial earthquake. In 2020, some of the Franklin Templeton debt funds hit crisis. Accounts were frozen and investors had to wait for months to access their money. It's like being locked out of your own party. In 2019, just before that, DHFL had a bond default. Capital eroded, leaving investors shocked. Poof, the money just vanished. The second one is the interest rate risk. Debt isn't just about collecting interest, it's also about the bond prices. When the interest rates rise, bond prices fall and your earnings can take a hit. In 2022, for example, RBI rate hikes caused long duration debt funds drop in value. It's like the financial balloon deflating. And the most important one is the credit default and liquidity risk. Higher returns in debt often mean higher risks. Corporate bonds and NBFCs may offer better yields, but they come with the risk of defaults and downgrades. For example, in the 2018 IL&FS crisis, many NBFC bonds lost value. It's like trusting a friend who sometimes forgets their wallet. Debt is not always as safe as it sounds. You pick the wrong kind and you could lose your principal, unlike in equities where only your returns get affected. Another very important aspect is safe debt. Many times barely beats inflation after taxes. A reality check. Now, let's talk about the biggest problem with the traditional debt investments. Inflation and taxation eat up your returns. right? The post-tax return on safe debt investments in India. Let's look at some post-tax returns on some of the safe debt instruments in India. Fixed deposits typically give about 6 to 7% pre-tax. That's about 5% post-tax return. Barely keeping up with inflation. It's like running on a treadmill and staying in the same place. The government bonds, called G-Secs, typically offer between 6.5 to 7%. They are safe, but typically don't give you real growth because of the taxation and inflation. It's the financial equivalent of a participation trophy. Public Provident Fund, PPF, typically gives between 7.1 and 8% tax-free, but then you are locked up for about 15 years. It's like a long-term financial commitment that you can't back out of. Second important point is inflation and taxation erase real gains. If inflation is at around 6%, your real return on most of the fixed income options is close to zero. It's like paying for a movie ticket and falling asleep. The most important point, therefore, is that in order to get higher returns, investors must take higher risks also in debt. Here is what it looks like. There are credit risk funds, A-, AA-, sometimes junk, offering 8%, 10%, 12% returns, but the default risk is very real. It's like playing with fire for a little extra warmth. There are corporate bond funds, they offer higher yield, but do watch out for downgrades. It's like trusting a weather forecast that's many times wrong. Then there are NBFC and perpetual bonds, 9-ish% returns, but liquidity issues. It's like finding treasure, but not being able to encash it. And let's not forget, people lost money in IL&FS and DHFL, and they had to wait for months in case of Franklin Templeton debt funds. So, if you have to take risks in debt, why not just invest in equities for higher long-term gains? If you're going to gamble, might as well play at the high-stakes table. So, why invest in debt at all? This is the fine, it's actually useful part. After all this, you might be thinking, should I just ignore debt? Not so fast. First one is that debt gives you portfolio stability and diversification. Debt investments reduce overall portfolio volatility. It's like having a sturdy anchor in a stormy sea. Remember in 2008 crash, stocks fell almost 50%, but debt funds remained stable. It's the financial equivalent of a safety net. The second is it provides liquidity for emergencies. Unlike stocks, debt investments can be easily liquidated. It's like having quick access to your emergency stash. Another example is the COVID-19 lockdown. Many investors had to sell stocks at a loss because they didn't have liquid investments. It's like needing cash and only having a rare coin collection. The third one is a tactical allocation in certain market cycles. Debt works well when the interest rates are high but expected to fall. It's like timing the market with a less risky strategy. Example, the RBI rate cuts in 15-16 led to a double-digit returns in gilt funds. It's like finding a hidden sale just before the price drop. The fourth is the retirement and income stability. Equities may create wealth, but retirees need steady income. Like needing a reliable paycheck, not just the potential riches. Senior Citizen Savings Scheme or SWPs in debt funds ensure cash flow. It's like having a reliable stream of income. Fifth, it could mean safety for short-term goals. If you need money in the next 1 to 3 years for a house, education, wedding, you shouldn't put it in equities. Like not using trampoline to carry fragile items. Now to conclude this discussion, the right approach to debt investing is about balance. First, debt can outperform in certain phases. Indian bonds and debt funds have beaten equities during economic slowdowns. Debt is not risk-free. Defaults, interest rate risk, and liquidity issues can wipe out capital. Safe debt barely beats inflation. FDs and PPF may feel safe, but they don't create wealth. Equities generate higher returns but are volatile. Debt provides stability, liquidity, and protection. So therefore, a balanced portfolio combines debt and equity. Ignoring debt is risky, but over-relying on it erodes wealth. So what's the right mix? Debt is for stability, equities is for growth. That's how you build long-term wealth while staying financially secure. And that's a wrap on today's Wealth Waltz with Walunj. If you enjoyed this episode, hit the subscribe button and comment with your questions. I'll try and answer as many as I can. I'll see you next time as we keep waltzing towards smarter, wealthier investing. Catch you soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.